it has become very difficult to save money in today's economy with the inflation being high. So in today's video, I'm going to show you how you can buy a home with just 3.5% down using the FHA loan program. Then I'm going to share with you loan requirements that will show you exactly what you need to get qualified for this program and how this program really works. And towards the end of the video, I'm going to share pros and cons of this program that will help you determine if this program is fit for your buying needs. And lastly, I will share with you on the board a real-time scenario and show you what your payment would look like if you use the FHA loan program to buy a home in today's market. So you definitely want to stay till the end. The FHA loan has helped thousands of people in this country buy their first home. So let's see how this program can help you. We're going to talk about the loan requirements first. Then we're going to talk about the pros and cons of this program and some cool benefits that a lot of people don't know about this program. And then lastly, we're going to talk about our real-time scenario. So starting off, this program requires 3.5% down, minimum down payment to be able to qualify for this program. Credit score, you can go as low as 500. Each sponsored lender, so this is a government-sponsored program. Each lender's guidelines may be a tad bit different, but there are lenders out there that will allow you to have a 500 credit score and you could still qualify for this program. Now, if your credit score is below 580, say it's 579 to 500, so 500 to 579, you would be required to put 10% down. But if your credit score is 580 or above, you can utilize the 3.5% down payment. Moving forward, this is one of the most lenient loan programs out there. When I say lenient, they have very lenient credit score requirements, as you just saw above, and also debt to income requirements. Debt to income is a requirement that says that, you know, if you have a car payment, student loans, child alimony, and other expenses, this program allows you to have more expenses and still be able to buy a home with those expenses there. Typically, on a conventional loan, the DTI is usually around anywhere from 43 to 45%, and FHA allows you to go up to 57%. Now, again, the same rule applies here. Not all lenders will allow that. This number may sit around 51 to 52%. Depending on what lender you're working with, what your credit score is, and you know where the property is, and all the scenarios put together. So you will have to run your numbers with a professional, but they in some cases will go up to 57%. What do I mean by DTI? Let me just explain this in a little bit more layman terms. So if you are, say, making $100 in income, sorry, my pen is running out here. And your debt, including your mortgage payment and your car payments, is $45. This is your debt, and this is your income. Okay, so the lender is saying that this will qualify because your debt is below 57%. So this loan allows you to have up to almost 57% debt compared to your income. So that's how that works. Now, moving forward, this loan is only for when you're purchasing a primary residence. You cannot use the FHA loan program to buy an investment property. This may only be utilized for primary use. Moving forward, you have on this program, anytime you put less than 20% down. So if you're putting less than 20% down, in this case you're putting 3.5% down, you're always going to have something called mortgage insurance that gets added on to your mortgage payment. You don't need to think about this too much. I'm going to visualize this for you on the board when we look at the scenario at the end of the video. So it's going to have mortgage insurance. Moving forward, it also has something called upfront MIP, which is charged one time and it's financed into the loan. So this is sometimes not liked by some people, but if I had to explain this to you right now, you don't have to worry about paying this out of your wallet. you would just worry about paying the 3.5% down. The upfront MI, which is a financing charged by the FHA, gets rolled into your loan. It will increase your principal balance, but you don't have to come out of pocket for the upfront MIP. The last requirement that I want to talk about here is proof of income. Now, we looked at all of these other requirements here. They do require that you have worked, the lender requires that you have worked in the same line of work for at least 2 years. Now, if you had a job gap because you got laid off, or you're on maternity leave or paternity leave, or you're taking care of a sick mother or father or family member, those are circumstances that you can write a letter of explanation, and in most cases, you will still qualify. But for the most part, they want to see a consistent, steady flow of income and have a consistency when it comes to the duration of time you worked with your employer. Now, moving forward, let's look at some of the benefits and some of the cons of this program. So some cool facts, which are benefits I want to talk about, is that this program has the shortest waiting periods. So say, for example, you've had a bankruptcy Chapter 7, or you've had a foreclosure in the past. When you go qualify for a conventional program for a Chapter 7 bankruptcy, they ask all borrowers wait for at least 4 years. But with this program, you only have to wait 2 years until you can utilize this program. And as far as foreclosures go, this is incorrect. It says 7 years here, but that's for a conventional program. For the FHA, it's only 3 years. So the waiting period for a foreclosure is only 3 years. The waiting period for Chapter 7 is only 2 years, which in both cases is almost, half the time that you need to wait for a conventional loan. So guidelines are definitely more lenient on the FHA side. Moving forward, you have you don't have to be a first-time buyer. You do have to be purchasing a primary residence, but you may have purchased a property a year ago, 2 years ago. It doesn't matter. As long as you're purchasing a primary property, it's going to be for you to live in as your primary residence. You can utilize the FHA program. You don't have to be a first-time buyer. Then you can, which is a lot of people call this house hacking, you can utilize the FHA program to buy a multi-unit property. So a multi-unit 2 to 4 units. So obviously you're using this for a single family condo townhome, but if you see a duplex or a quadplex or a triplex, you can utilize the 3.5% program, live in one unit, and rent out the other units. Now, this, you have to talk to a professional on here. I'm not going to go dive really deep on this because it's going to require some more time. But I'm going to simplify this for you. If, say, for example, you buy a 4-unit property, now the 4-unit property is earning you $5,000 in rent, right? The lender is going to take 75% of that rent, not 100% of it, 75% of it, and use that to see if that rent covers your PITIs for the property you're buying. When I say PITIs, that means principal, interest, taxes, insurance, and mortgage insurance. Does 75% of that rent cover it? And if it does, you can qualify. So this is a little bit tricky. It may work in some areas and it may not work in some areas. In high cost areas like here in the Bay Area, this program may not work, but in areas like maybe the Sacramento, Fresno, or middle of California or other parts of the country that are low cost areas, the house hacking formula may work, but you definitely want to talk to a loan professional and dive in deeper, and you may be able to take advantage of this. Live in one unit and rent out the other units where you're getting income now and your mortgage is being paid by your tenants, and you bought it with just 3.5% down. Now, moving forward, we have some negatives here. What are the cons? Well, the cons are there are loan limits to this, right? So if you're in a high cost area, the loan limits are higher. If you're on low cost area, the loan limits are lower. So let's look at some of these loan limits on the board. So if you're in the low cost areas, your 1 unit is 472, and then your 4 unit is 907, 920. If you're in a high cost area, as you can see, the 1 unit goes up to $1,089,000, and a 4 unit can almost go up to or not almost, but goes up to $2,095,200. I have also added a link in the description of this video that you can click on and see what county you're in, and it will tell you what your loan limits are in the county you're trying to buy in. Now, moving forward, high MIP. MIP stands for mortgage insurance premium. Like I mentioned earlier, whenever you put less than 20% down, you're going to have mortgage insurance charge on your monthly payment. Now with the FHA, if you are getting the FHA loan with 3.5% down, you're going to have the mortgage insurance for the life of the loan until your home equity grows and you actually go and refinance into a conventional mortgage. That's the only time the mortgage insurance will go away. Or if you've bought it, say with 10% down, then after 11 years, after the 11th year, the mortgage insurance will fall off. But if you're buying it using the 3.5% down, which has been the basis of this video, and you want to utilize the LOAN program, then the MIP or the mortgage insurance will stay on the loan for the life of the loan until you actually refinance out of that mortgage. Now, there are no prepayment penalties on these programs because consumer law applies. So as long as your equity increases and your loan value comes down, depending on how fast the appreciation is going up and how fast you're paying the mortgage down, you may be able to refi in a couple of years and get rid of the mortgage insurance. But if you don't refi, it'll stay there. If you're getting real value out of this video, please smash that like button, because when you hit that like button, more people like yourselves that need to watch this video get shown this video by YouTube. And if you're getting and loving the content that I'm sharing with you, please don't forget to hit that subscribe button. I love to hear from you. Thank you for watching. Now let's look at a real-time scenario on the board for someone that's purchasing a $400,000 home with only 3.5% down, so you can get an idea to see how all these mortgage insurance are assessed. So let's get started. So if you are buying a $400,000 purchase price, your down payment would be 3.5%, which is 96.5% LTV, which brings your loan amount to $386,000. So your initial loan amount is $386,000, and the upfront MI, which is 1.75% of that initial loan amount, which will equal $6,755. And like I had mentioned to you, this is going to get financed into the loan. So if you broke this down and you added this back to the initial loan amount, your final financed loan amount is going to be $392,755. Now your monthly MIP, which stands for mortgage insurance premium, which is assessed at about 0.85% of the financed loan amount. So if you took the financed loan amount and multiplied it by 0.85%, it gives you $3,338.42. And if you divided that by 12, it gives you your monthly MI, which is going to be added to your mortgage payment, and you'll see, of $278.20. Now let's look at what your payment's actually going to look like. So if say you're getting a 30-year fixed loan at 5.5%, and the loan amount is $392,755. So property taxes on that are going to be 1.25% of the purchase price, which equal to $416.67. Hazard insurance is going to be $100 a month, and your total payment with everything included is going to be $3,024.89. If you think you can qualify for this program and the numbers make sense to you, I will highly recommend talking to a local loan professional to figure out if you will qualify for this program. So if you need help finding a local professional that's making moves in your area, click in the link below and we will connect you with a local expert. Like always, I love creating this content for you. That's all I have for today's video. I hope this was insightful. Until next time, this is Karan Singh.